Welcome back, everyone. I hope you're having a great day. And in this episode, we're going to take a look at two companies that some of Wall Street's top performing analysts believe are a buy in 2023. This article is published by CNBC and it outlines 5 companies that they believe are a buy to start out this calendar year. So I went through the 5 companies listed in the article and determined which 2 I believe are the best buy at their current share price, and that's what we're going to focus on in this episode. The 2 companies we're going to go over are very different in terms of their operations. We have one high-tech growth company that continues to expand revenue at over 20% annually, and the second is a high dividend payer that consistently grows their business at a slower rate year over year, but generates a massive amount of consistent cash flow. So for these companies, we're going to take a look at their current operations and their future growth expectations, and of course, their current valuation metrics. But before we jump into that first stock, I am going to ask you to please hit that like button and subscribe. I'm the Gen Z investor, and on this channel we talk about the stock market, go over everything dividend related, and of course we track the progress on my personal portfolio that now has a value of $170,000. So please hit that like button and subscribe. And now we're going to jump into the first analyst recommended stock in 2023, and that is ticker GOOG for Alphabet, also known as Google. The company currently trades for $86 per share, and during the past year there's been a major pullback, and the company is now down over 38% from their recent high. They trade with a forward PE ratio of only 18.8 after the recent pullback and are sitting very close to the 52-week low with a market cap at $1.16 trillion. So we all know Google. It's one of the most powerful tech companies in the world right now. They considerably grow their revenue year over year, and the company posts a massive amount of positive free cash flow. If we take a look at a Morningstar report, their estimated fair value for the company is at $143, meaning at the current share price, it's estimated to be trading at around a 38% discount from their value of the company. So right now you can pick up Google at a major discount, trading at around $87 according to Morningstar. And if we jump back over to that CNBC article, they believe Alphabet is well positioned to capitalize on long-term digital ad trends, participate in the shift of workloads to the cloud, and benefit from a digital transformation. And their price target for the company sits at $135. So again, significant upside in the stock and its expectations for 2023. And just to get it out of the way, if we jump over to their financial statements, this company is one of the best set of financials I've ever seen. First, if we take a look at the income statement, total revenue continues to expand at a massive rate year over year from $110 billion back in 2017 to all the way up to over $282 billion in the trailing 12 months. And this company has very high margins and they generate a ton of net income and cash flow based on the sales they generate. And we can see as total revenues continue to expand, so does their operating income, hitting a record high of over $78 billion during the trailing 12 months. And one thing that's very impressive with Google is their ability to turn these operating profits into actual cash and free cash flow. So if we take a look at their chart of their historical cash flow over the past decade, back in 2013, they generated $11.3 billion in total free cash flow. They've been growing this annually at a CAGR of 21.59% to over $62 billion of total free cash flow during the trailing 12 months. So this company is a cash machine. They generate more and more cash quarter over quarter. It allows them to reinvest back in their business. It allows them to grow at an astounding rate. I personally don't see any major market environments going forward over the next 5 years that are going to cause a major slowdown in Google's business in any way. Although recently there have been some negative headlines surrounding the durability and the moat of the Google search engine, I think those are just negative headlines. This company's search engine is a beast. They're the number one in their industry and they pretty much control the entire market. And going forward, that's not their only growth driver of their business. Next, if we discuss the Google Cloud, that's pretty much the main focus of Google going forward, and it continues to grow at an astounding rate. Google Cloud already has some of the largest companies in the world as their clients, and their client base only continues to grow as the cloud advances. And if we take a look at the cloud revenue, quarter after quarter, they've seen incredible expansion of the top line revenue growth from their Google Cloud segment. In the second quarter of 2022, they posted $6.3 billion of revenue directly from Google Cloud, which was a CAGR of over 44%, which is incredibly impressive, and quarter after quarter continues to grow at a rate of over 40% annually. And if we take a look at the most recent quarter, that grew to over $6.8 billion, 6.3 in Q2 to over $6.8 billion of cloud revenue in Q3 of 2022. So overall, their cloud business, which is going to be a large profit driver going forward, is contributing top line revenue growth and will be profitable over the next few years, leading to net income growth as well. So although Google may have some negative short-term headlines in the market right now, there's many areas of their business that continue to grow at a very fast rate, leading to what I believe will be strong financial performance in the future. As well, if we take a look at YouTube, YouTube has been an incredible acquisition for the company. The platform has become one of the world's leading search engines and continues to generate growing revenue annually for Google. And with YouTube, this company generated more revenue in a single quarter in early 2022 and actually surpassed Netflix in terms of revenue in the same quarter. YouTube, a video streaming service, surpassed Netflix, which is considered the leader in video streaming, in quarterly revenue in early 2022. And there's a very big difference between these two companies, and I believe YouTube's revenue is much more valuable compared to Netflix. For Netflix, they have to invest $15 to $20 billion annually in order to create the content for their streaming service. YouTube and Google, they don't have to do that. They don't have to invest $15 to $20 billion just to create the content or to generate that revenue, because the content is generated by different creators, like myself, who create content for YouTube in order to earn a portion of that ad revenue. So I do believe YouTube's ad revenue that is now higher than Netflix's is way more valuable than the revenue Netflix generates. And alone, like I mentioned, Netflix is a $200 billion company. So YouTube is a beast within Google that many investors underlook. YouTube right now makes up around 10% of Google's total top line revenue. I do believe that number will continue to grow at a fast rate going forward, and they're going to make up more of a significant portion of Google's overall business. And another thing to note with YouTube is the new subscription service, YouTube TV. This pretty much came out in 2020, and this generates, like Netflix, monthly recurring revenue into the business and has now surpassed 5 million subscribers. And that subscriber number continues to grow quarter after quarter. And if you've seen any of my previous videos, you know that I'm a big believer in the subscription-based revenue model because of the predictability of their future cash flows. And one thing I like about YouTube and Google is they have a major focus on YouTube TV and growing the subscription service going forward over the next few years. And in the past month, they just unveiled their biggest deal yet. They just bought a 7-year contract to host NFL Sunday Ticket in a $2 billion annual deal. This deal is absolutely massive. Sunday Ticket, one of the most popular sports services in the world, especially in North America, is now going exclusively to YouTube. We don't have the details exactly how much it's going to cost the consumer going forward. This deal was just announced in late December 2022, but this is a major deal for YouTube. They're going to get millions and millions of new subscribers heading over to their service in order to subscribe to watch NFL Sunday Ticket. I'm a big believer in this deal. I think this was great for YouTube. They may lose money up front over the first 2-3 years, but I think over the long term, the subscribers base they're going to build based on this deal is going to generate a ton of cash flow for the business. So overall, although the news headlines recently have been saying Google's business is going to slow down, there's been a lot of negative turmoil regarding the company, I really don't see that happening. We just outlined a few areas of their business that have been growing in the high double digits year over year with no signs of slowing down. And I do believe there's many other areas of Google's umbrella that will continue to post record-breaking profits and revenue numbers going forward over the next 5 years. So I do believe it's a great stock to consider in your portfolio to start out 2023. And the last thing we're going to discuss regarding the company is their balance sheet. Google is one of the strongest balance sheets in the world right now. The company has over $116 billion of cash sitting on the balance sheet as of the latest quarter. If we compare that to their liabilities, short-term debt for the company sits at only $66 billion, meaning they have close to 2 times the amount of cash on hand in order to handle all their short-term liabilities. And if we take a look, the company only has $14.6 billion of long-term debt. Total debt for the entire business, Google, worth over $1 trillion, is only at $104 billion for all the debt on the balance sheet. If we take a look, they can pay off every single dollar of debt with just the cash on hand right now. This company is in a very strong, very healthy financial position. They have a ton of cash on hand in order to do acquisitions, and I think overall this business is well positioned in order to fund future research and development and growth over the next 3 to 5 years going forward. So Google overall was the first stock recommended by analysts for 2023. They've seen a major pullback over the past 12 months and definitely worth doing some research into for your own portfolios. So now we're going to continue on and take a look at the second company we're going to discuss in this video, and that is ticker VZ for Verizon Communications. They currently trade at $41 per share, and like I mentioned right at the start, the second company is very, very different than Google. So with Verizon, it's one of the world's leading telecommunication giants. They've seen a 23% pullback over the past 12 months. They have a market cap at $168 billion, trading somewhat near the middle to the low end on the 52-week range. They have a very, very low forward PE ratio at 7.73 and an absolutely massive current dividend yield at 6.5%. So with Verizon, this is a value company. This is a high dividend payer. It's one of the highest yielding companies on the market that actually pays out a safe dividend. And this business does not grow at a rapid rate. It pretty much sees slow and consistent growth year over year. If we take a look at the Morningstar report, their estimated fair value for the company sits at around $55 per share, meaning Verizon is now trading at close to a 28% discount at this current share price, according to Morningstar. And overall, Verizon's business, like I mentioned, is not expanding at a rapid rate, but they're still growing annually. The company continues to add more and more subscribers, and in the latest CEO report, they announced positive subscriber growth in the latest quarter, which is great to see. And if we jump over to their financials, their total revenue during the past quarter that they've already shared grew top-line sales by 4%, and their largest business segment grew sales by 10.8% year over year. So it's great to see that this company can still grow at a decent rate. And now if we take a look at their cash flow, in the first 3 quarters of 2022, they generated $28.2 billion of cash flow from their operations, and they invested $15.8 billion in capital expenditures. If we take a look at 2021, they invested $13.9 billion during that same period. Capital expenditures for Verizon over the past 3 to 4 years have been heavily inflated. This will always be a company that needs to invest in infrastructure in order to grow, but over the past few years, these investments have been greater than the company would like. And that's because they've been building out their 5G infrastructure. It costs a lot of money to transition their entire network onto 5G, and that's what they've been doing. So recently, over the past 2-3 years, their free cash flow numbers have been reduced due to these massive capital expenditures. But going forward for investors, that number is coming down, and they will no longer need to invest so heavily in order to build out their capital because they've already done it. Their executives during their latest conference announced that we expect to see quite a dramatic reduction in capital expenditures, which is a great sign for free cash flow. That number is going to be inflated going forward, and there's going to be more cash flow available to pay down their debt and also pay out their dividend. And they're not doing this because they can't afford to. They're doing it because they've already done everything they needed to do. A quote is, "It's not because we're not doing everything we want to do, but rather because Verizon has made investments in areas like edge and computing, and now they can reap those rewards. They've already put up the upfront capital in order to build out their infrastructure, and now they can generate the positives and the free cash flow from that existing infrastructure that's in place." So we can see the company generated $12.4 billion in free cash flow throughout the first 3 quarters of this year. They paid out $8.1 billion of that in the form of their quarterly dividend. And if we take a look at that dividend, it has a massive yield at 6.35% with a very conservative payout ratio of only 48% of their net income. So for most companies that have a yield above 4, 5, 6%, usually they have very inflated payout ratios and they're paying pretty much all of their earnings and all of their cash flow. But we can see with Verizon, they're really not doing that at this current point in time, and the dividend is considered very safe according to Simply Safe Dividends with a score of 87. So overall, this company pays out a very safe dividend with an absolutely massive yield at around 6.3%. So for value investors who are looking to add some passive income into their portfolio, Verizon is definitely a company worth taking a look at. And if we jump over to their income statement, the company, like we mentioned, although not growing at a rapid rate, is still expanding slightly. $126 billion of total sales back in 2017 that has now grown to $135 billion during the trailing 12 months. And one big concern with many investors discussing Verizon is the amount of debt they have on the balance sheet. They do have a lot of debt on the balance sheet at this current point in time. But if we take a look at their EBITDA, it comes in at $43.4 billion. So a very generalized rule of thumb is that you want your company to have less than 3 times EBITDA in terms of total long-term debt. That's just a simple balance sheet that shows the company's ability to generate enough earnings or EBITDA to pay off their debt going forward in the future. So if we take a look at the balance sheet of Verizon, their long-term debt at the latest quarter is at $135 billion. If we take a look at that EBITDA number generated of 43.4 and multiply that by the general ratio of 3, that gives you $130 billion to be the metric to determine the safety of the debt and the healthiness of the balance sheet. So we can see right away they are slightly above the $130 metric, but that is just a general rule of thumb. You can't apply that rule strictly to all businesses equally. Verizon generates consistent and predictable cash flow due to the nature of their business, people paying a monthly fee to use their services every single month. And in the world we live in, it's very unlikely people are going to cut their Verizon subscription if their wages go down. I think consumers are going to find other ways to reduce costs instead of reducing their phone plan or their internet connection. So overall, I think this company can manage their debt. Of course, this is a very large number at $135 billion, but I do believe going forward, the management has done a great job of already starting to deleverage. We can see they already did reduce $8 billion over the past year. And I think the company, because they're going to have reduced capital expenditures going forward, they're not going to have to take on more debt. They're going to have greater positive free cash flow that they will use to pay down the debt over the next few years. So overall, not too concerned with the balance sheet at this current point in time. I do believe the dividend is safe, and I do believe because of reduced expenditures, they're going to pay it off rapidly going forward over the next 3 to 5 years. So overall, that was kind of an overview on Verizon as well. This company is again recommended by analysts to start out 2023. The company is a major dividend payer with a yield above 6.5%. So if you're looking for some passive income, definitely a stock worth taking a look at. And of course, if I wrap the video, the first company we took a look at was Google, one of the top tech companies in the market that's been growing at a rapid rate over the long term, but has seen a major pullback as of late. So if you're interested in investing two companies that analysts on Wall Street like for 2023, definitely take a look at Google and Verizon. Two of them were included in the top 5 from analysts for this calendar year. They were the two I believed were the best buys at this current point in time. And according to Morningstar, both companies are trading at a significant discount from their estimated fair value. So definitely worth taking a look at. I want to thank you for watching the video all the way to the end. If you've stuck along with me, please hit that like button and subscribe, and I will see you in the next video.